David, thank you so much for joining us here at FundForum International 2017. Your specialist subject, if you like, if you could tell me a bit about what's happened in high yield over the past year and where we're going forward with it now.
Yeah, I mean, the asset class has seen a huge recovery since the lows of February last year when we were recovering from what happened in the energy space in US high yield. And a lot of investors do ask us, with so much of a recovery in the market, what's left in it. But I think it's important for investors to keep in mind that the returns in high yield are dominated by that carry, by that income. And where we see valuations at the moment, we think that the environment where we're having synchronizing global growth, default rates coming back down again, that actually for investors swapping a little bit of interest rate or duration risk for a bit more credit risk makes a lot of sense. And because we take a global approach to the asset class, looking across it, we can see numerous opportunities for us to deliver good quality yield for investors.
You talked there about a global approach. That's challenging in itself at the moment though, isn't it? What challenges do you face?
Well, there's always something going wrong pretty badly somewhere, and that's never going to change. But I think one of the advantages of being global in approach is that you can pick your spots. So if you take a very regional approach, and a lot of high yield investors do take a US or European centered approach, then you're kind of forced to make calls in parts of those markets that mightn't be as attractive. Whereas if you take a more global approach, and we also tend to have more concentrated portfolios, so we don't seek to own everything in the market or there's whole parts of the market we're able to just avoid. So at the moment we consider emerging market high yield to be have poor risk reward characteristics, so we just don't buy any of it. Similarly, long dated high yield we can avoid. So when you're global, you open up the opportunity set and you can really tailor and take those risks that you want in the fund.
It's important for you to be flexible, if you like, and able to spot the opportunities when they arise.
Yeah, certainly. So I mean, what's central to the Kames approach to running high yield is we don't believe that an index or what the market looks like is the best starting point for building a fund, particularly in a high yield asset class where you're lending to risky companies. So the starting point for everything is zero. We only invest in what we have high degrees of conviction in, and you do need to be flexible in that approach and have the kind of conviction and have the sort of investment philosophy behind that will allow you to just stick to where you think that you can derive the best returns.
So if I'm to ask you that really tricky question, where do the opportunities lie in the next 12 months? What would you say would be your answer at the moment?
Yeah, I mean, look, it's clear, we're in a synchronized global growth. Yields are still low. Inflation is starting to push through in very real effect, and we certainly see that in the companies we speak to every day. But for me, in a time when valuations are compressed, and that means the market is reaching for yield, but actually when you have a compressed market and everything's pricing at more or less the same level or very little discrimination between them, actually if you're an active fund manager, that allows you to de-risk your portfolios very, very effectively without having to give up large amounts of yield. Because if the market is overpaying for very risky stuff because it's just addicted to yield, you're able to step back from that and say, okay, well if you're overpaying for that part of the market, that means you're underpaying for other parts of the market, and that's where we try and build our funds off. And there's lots of opportunities out there. We look for inefficiencies in the market where, say between US and European high yield, where typically, say, a US company issuing in Europe or a European company issuing in the US, sometimes you can get pricing distortions there that we can try to take advantage of. So there's always opportunities out there for us.
One topic that came up in the panel discussions this morning was inflation. What are your thoughts on that and what impact that could have?
It's the thing that as fund managers we probably least enjoy but talk about the most. I think, one of the core attractions for high yield at the moment is that it does offer a real return, so you do get a yield that is, in advance of, in addition to what expected inflation is. We certainly are seeing some signs of inflation in the companies we talk to, but I would say that a lot of the demographic and sort of societal changes that are driving inflation lower, they haven't gone anywhere. So whilst we do think we will see a little bit more inflation, it's all going to be at very moderate levels, and I think that the interest rate environment will reflect that through time.
Thank you so much. Thank you for sharing your insights.
It's a pleasure. Thank you.